afternoon. I hope you've all eaten very well. I think that climate change is probably the defining issue of our time, and critical issues are going to be explored, of course, right here in Dubai at COP28. The topic of our panel discussion is economic and investment opportunities in the energy transition. In other words, how will the shift from fossil fuels to sustainable energy sources impact our economies? The shift is profound and driving transformations across industries, jobs, and investment. So it's with great pleasure that we're able to discuss these issues with such a distinguished panel and tap into their collective wisdom. We're going to have some time for questions at the end, so please do bear this in mind as we move along with the conversation. Firstly, it's the greatest pleasure to have you, Christof, with us. You've made a tremendous contribution to the AI summits in the past. You're currently a senior research scholar at the Center of Global Energy Policy at Columbia University. And of course, you served for a number of years as global head of research in the Abu Dhabi Investment Authority. Could you tell us, Christof, a little bit more about your current, very relevant research into fossil fuels and the energy transitions? What's your special focus on this critical area?
Thank you. Good afternoon, and thank you for having me here. I was always, from where I'm coming from, before I was at ADIA, I was in the oil and gas industry. Let's make no bones about it. I was chief economist at a large oil company. So maybe because of that, but I think more generally, I had always two fears about this energy transition from when the topic became popular. One was that it's going to be a lot more complicated than what people thought, and therefore the risk of failure would be much higher than what people thought. And therefore, the risk of admitting it is not so easy would create cynicism among, people like us, like all of us, and that is always the poison for any kind of development. And the other was the fear that there may be actually policy and then investment consequences and directions deduced from looking at it the wrong way and thinking it is easy, which would be very costly for all of us and which would actually be steps backward and not forward. And these two fears, that it is not as easy as we think and runs the risk of creating opposition and cynicism, and that it's actually going to be very costly and not just a free exercise in the latest ideology or so. You can look at them on a theoretical level where they come from, or on a practical level, and look at the practical level first. To just look back in history, we had only two of these energy transitions, if you define it loosely enough. The switch away from wood to coal in the 18th century, and the switch from as a dominant fuel, and then later the switch from coal to oil in the 60s or 70s of the last century. None of that was easy, of course. All of them were driven by economics, very different from today. But there's another difference which is rarely mentioned, which is none of them were just transitions to a different systems. They were energy additions just as much as traditions. The amount of coal we consume today is a multiple higher than when it has been what it was when it has been replaced by oil, and the same, of course, for oil. And the same, of course, for coal and for oil. It hasn't stopped. That another fuel became the most prominent. Hasn't stopped the replaced fuel from growing very fast. But in this transition, if fossil energy is the culprit, if 87% of our global system are fossil energy, and it's going to be replaced, then it cannot continue to grow. The strategy we have says explicitly, we want to replace fossil fuels, they're bad, with clean energy. And that would mean that the fuel, which is now overtaken by something else, the fossil fuels, would have to stop growing. And that is almost impossible. And very quickly you can come to it analytically, and there I want to just emphasize the core message here is that the way people think of this being a problem of substitution, you replace something, fossil fuels, with something else, renewables. It's not how it's going to work. As long as we have the intermittency problem, you cannot simply replace. You need to have backup generation, backup capacity, which is mostly fossil. Even if it's not fossil, it would be so much additional requirements for non-fossil fuels with our technology that it's not feasible. In particular, it's not feasible for fast-growing economies. You can do something like that in Germany or in Europe when your total energy consumption falls and you replace existing fossil with more renewables in order to compensate for the intermittency problem. Because you have falling demand, you can sort of over time fudge that. In a fast-growing economy, by definition, you cannot do that. And that's a technological constraint. That's not something where you can buy or manage your way out of. That's something which can only be resolved by technologies which are not yet available. And that's why I'm saying it's just going to be more complicated, takes more time, and requires, the right mindset. And I see the discussion move in the right direction, but still being way, way too idealistic.
Thank you. Thank you. Secondly, Jad Ellawn. Jad, you're managing partner at Brookfield and regional head of the Middle East. Brookfield has really been a pioneer in renewable energy, climate transition. Could you tell us more about Brookfield and how this became part of the corporate DNA?
Yeah, absolutely. So look, first of all, thank you for having us here. Overall, just very high level, Brookfield, we are an alternative asset manager. We manage $850 billion globally, and that's across a multitude of strategies. So real estate, infrastructure, renewable energy and transition, private equity, and then credit and insurance solutions. So to your point, one of our fundamental strategies is renewables and energy transition. We have raised the world's largest energy transition fund, $15 billion, which is predominantly deployed at this stage. And it focuses on three key areas. The first is the build out of renewable energy. The second is build out of an assistance in carbon capture. And the third is investing in the circular economy. And our view, I don't think is too far off, but our view is that there's a lot of money that's going to need to go into this. It probably adds up to trillions of dollars. We don't know what that exact number is, but it's a lot if you look at it globally. And we think there is a big monetization opportunity. And so our strategies actually yield returns on doing all of this good stuff. And so we publicly stated we look at 12 to 15% type levered returns on these deals that we're doing through that strategy. And it'll continue to be a big part and probably a very significant part of everyone's portfolio going forward.
Absolutely. I'd like to come to what you're doing specifically in the Middle East in a moment, actually. But thirdly, we've got the pleasure of V. Shankar with us. Shankar, you're co-founder and CEO of Gateway Partners. You raise capital for investment in Africa, Middle East, and Asia. You're also committed to ESG and the Sustainable Goals, UN SDGs. Could you let us know a bit more about your work at Gateway?
Thank you. Good afternoon, everybody, and thank you for having me here. Gateway, I was one of 4 co-founders of Gateway. We started the firm in 2015. We invest geographically across Southeast Asia, South Asia, Middle East, and Africa. We're sectorally agnostic, but having said that, we tend to focus on investing into companies that produce core goods and core services that's required every day across this vast growing middle class across this geographies that we cover. We are essentially focused on growth investing. We are not just an energy transition fund or a fund focused on renewables. We invest across the board, including in renewable energy and all the stuff which goes with it.
Thank you very much. Last but very much not least, Karim Moussa, you're co-CEO at EFG Hermes Investment Bank and CEO at Vortex Energy. Now, EFG Hermes has been a very powerful presence in the region for many years, but let's just focus on Vortex Energy. I think it's a platform to pursue renewable energy. Could you tell us more about Vortex?
Absolutely. Thank you, Dave. We've set up this platform 10 years ago in 2014. And the main purpose was raising money from the Middle East, getting out of the Middle East and focusing on European renewable energy transactions. The Middle East came right out of Arab Spring, and geopolitical dynamics at that time wasn't favorable for us to deploy in renewable assets here. We've raised so far $1.6 billion, fully invested in equity and debt, thereof over $850 million in equity, aggregating a series of wind and solar assets across a series of vortexes. We're now in our Vortex 4 vintage fund. 1 and 2 was a pan-European wind portfolio out of Portugal, Spain, Belgium, and France, which we've sold in 2019 to JP Morgan. Vortex 3 was 10 Terraform Power, Sun Edison's, Yieldco, their UK solar portfolio of 360 megawatts, which we've acquired and then sold in 2020 to Tenaga, the utility out of Malaysia. In aggregate, we delivered 15% returns to our investors, 1.4 times cash-on-cash multiples, and we were paying roughly 5% net cash yield to our investors. We're now in our fourth vintage fund. We manage around, with its co-investment, around 360 million euros. We have two companies in the portfolio. One is a major integrated renewable energy player out of Spain called Ignis, which we've invested roughly 160 million euros of in the last 2 years. And the latest one we've acquired earlier this year, which is in electrical vehicle charging, is a company called AO Charging, which is focusing on charging stations for fleets and buses. So we've been always in the industry, and we've seen the change in the industry. I agree with Christof that is, the transition hasn't happened yet. We're still polluting more than year on year than we're saving. Greenhouse emissions are peaking this year and next year, according to DNV. But there is a lot of opportunities out there to invest as private equity. The industry has shifted, happy to discuss this in a bit, from infrastructure to private equity, and the landscape is very specific. There's a lot of talks and little actions, but if you roll up your sleeves and look at the opportunities, there's tangible investment opportunities for private equity to deploy.
Absolutely. Thank you very much. So, Jad, perhaps I could turn to you, the big picture. I mean, when you look at the world today, we're undergoing this incredible renewable energy transition. And I guess the term renewable energy can cover a vast number of technologies, but maybe perhaps distilled down to decarbonization and electrification. Where do you think we're making the most progress?
Well, I think undoubtedly the biggest progress has been made in the build out of renewable energy. So let's put that to the side, because that's been going on for quite some time. What we're seeing now as a big opportunity is actually taking businesses that previously might not have been fully compliant with some green standards and trying to turn them into being that in the future. And so that's the trend, literally investing into the transition. One example of that, which has been publicly mentioned, we're still going through a process of acquiring Origin in Australia, which is one of the largest utilities there, has quite a number of coal, let's say, fired power plants, which we're now looking to acquire. And we've publicly stated that we look at building that in the future through renewable energy and converting the current supply or the current capacity with future capacity of green. I think what we're seeing as well in this region is an increasing amount of industrial companies as well as large oil companies start to think quite a bit about the carbon capture opportunity. Where we need to do a bit more work, I think, in advancing that, where the GCC can push that further, which Europe and the US have, are somewhat structured markets to enable that and motivate, incentivize that through some sort of monetization. So we see a big opportunity here. In other sectors as well, particularly in commercial and industrial, and building out specific renewable energy for the commercial and industrial space, which doesn't necessarily does not necessarily compete with the much larger types of projects that probably everyone reads about.
Got it. Thank you very much. Shankar, could I move to you? The same type of question. Where do you see we're making progress, and perhaps where are we failing to make progress?
I think what Jad said, I would echo that. I think there's a whole swath of stuff we can look at here, whether it's in terms of renewable energy generation or EV chargers or any number of things. Now, let me just highlight a couple of things. One, to Jad's point, in terms of what can we do to reduce the amount of carbon emission. So if I just take a couple of examples from our portfolios, we have a stake in Africa's largest cement company, Dangote Cement. If you take cement as a country, it will be, as an industry, probably the third or fourth largest polluter in the world of carbon. So do we go around saying, let's not invest in cement and Africans can't have cement and they can't have development? The answer is no. But the challenge then is, how do you make the process of making cement less carbon intensive? So one of the areas we were focusing on in that company is by using more alternative fuel in the kilns. So we've already taken the alternative fuel ratio from 0% to 10% of the thermal requirement, and our challenge is to take it up to all the way to 40%, 40. Same example, data centers. We happen to own Africa's largest optic fiber and data center business. Again, data centers are major users of energy, but how do we install our own solar farms to feed the data centers? That's the other way you can greenify. Finally, if you just look at this entire decarbonization debate, with transitory energy, the major challenge is going to be storage. Storage means batteries, and batteries require minerals. And I believe that this entire energy transition debate is going to ultimately come around, do we have enough storage? And to have storage, do we have enough minerals? So we have invested actually in a company that is developing a portfolio of minerals and metals that are absolutely critical to make this equation work. Let me just highlight it with one example and then I'll shut up. If you just take a battery, it's made up of essentially an anode and a cathode. And if you take the anode, 90% of it by volume is graphite. So when people talk about lithium-ion batteries, frankly, 45% of that by volume is graphite. More than 90% of the graphite in the world is controlled by China, number one. So that's a geopolitical angle to it. Number two, the global consumption production of graphite last year was 1 million tons. If you do the math, basic math in terms of EVs and renewable energy, in the next 10 years, you would require, in 2032, your global requirement of graphite is going to be 5 to 6 million tons. Where is this additional 4 to 5 million tons of graphite going to come from? We are going to be potentially part of the solution, but there's a lot more investment which needs to go into the minerals and metals sector.
Thank you very much. Karim, I mean, just to drill further down a little bit on the investment and finance topic that we're focusing on. Obviously, like in any financial structure, you've got risks, perceived risks, uncertain returns, and the need for upfront capital. And the solution has sometimes been through collaboration between governments, international financial institutions, and private sector. How do you view this type of cooperation? Have you been involved in any of these type of cooperation systems?
Yeah. I think we need to go back in time and just remind ourselves how the investing in renewables started. When we started in 2012-13 looking at the industry, it was unheard of to invest without subsidies and incentive programs. We were all financial investors chasing one specific theme. 20, 25 years guarantees by, specifically in Europe, for instance, European governments, European sovereign. They guarantee the offtake, they guarantee pricing, sometimes indexed to inflation, for 20 to 25 years. So it was a pure yield play and a very risk-averse approach. In fact, it was like an infrastructure investing, a core plus strategy. That has gone. In the last 10 years, cost of production of the levelized cost of energy production of solar and wind went roughly down by between 80 to 90% in cost. There is no more subsidies in most of the markets. There is no more feed-in tariffs. So it's becoming a commodity and it's becoming competing against all other sort of fossil fuels out there, whether it's gas or coal or others. So the opportunity landscape has changed and it shifted from infrastructure core investing into private equity. You need to take market risk, you need to take development risk, and it's a different landscape. As mentioned earlier, the energy transition space is so wide and you can get lost in looking at various opportunities with a high level of degree of risk depending as well on the technology. We summarize it in 4 verticals. One is upstream, which is effectively generation of electricity, which is the bread and butter of the whole industry, which is power generation through solar and wind. Which has a huge potential still to invest in. As mentioned, developers now take market risk. You're taking a different aspect of the value chain than before. And you've mentioned batteries and storages. The more renewable energy come for net zero purposes, and also for energy security, the more you need to install storages to offer base load and the volatility of renewables. So that's an area of strong interest. And then for us, downstream is electrical vehicle charging. EV charging is something that is very hot these days. We all know that the demand will come by 2030, 2035. The infrastructure is not there. And it's effectively consuming and distribution of your generation, your upstream that you've done before. These three verticals offer a lot of opportunity from an investing point of view. They come with market risk because there's not anymore a core strategy. And then far right, the fourth vertical that we look at is hydrogen and the whole hype around hydrogen. It's coming, but for us at the moment, it's still not investable. It still needs a lot of subsidies and an incentive program to make it commercially viable, but it can change very quickly like we've seen in the renewable energy space.
Thank you very much. Jad, when you look at your portfolio, can you generalize what type of structures you've been using? And my second question is, have you used public-private partnership finance in many of your financings?
So look, we don't have a firm rule or anything in terms of structures. I mean, we have a very large development business, and that is first and foremost where probably we're seeing some of the better returns. A lot of existing assets over time got bid up, and so acquiring existing assets sometimes, when it comes to renewables in specific, maybe doesn't give the same return as the development opportunity. And so I'd say that's been a key part of that strategy. On the rest of our investments, I think as long as we fit the structure within the target return threshold, we're okay. Whether even in this part of the world, I think we've seen opportunities that are coming out, whether it be tail gas treatment, i.e. sulfur capture. We know that carbon capture opportunities are coming out. These are not necessarily being driven as PPPs, but they're being driven as outsourced type, let's say, services that investors can take on behalf of the off-taker. And that could prove to be fairly attractive, particularly because what we've seen is that the banking world is very happy to finance projects like this. And so even if I take a very simple example like ICD Brookfield Place, which is a tower that we own 50% with the sovereign of Dubai just down the road, the financing terms that we've been able to get on that are more attractive than what we're able to get on other parts of our portfolio because it is a LEED Platinum building. There you go. And so one aspect of it is, okay, how do we invest in the transition? But the other one is, how do we move the rest of our businesses into a place where we can benefit from these types of, let's say, not underwritten opportunities to get some extra return?
Thank you very much. Christof, have you got any general observations on financial cooperation between governments, international institutions, and private equity houses, for instance? How's that trending in your view?
Demand for generalities. No, I think two very more specific ones. So initially you asked, so where has the success been the greatest? And I agree, it was the build-up of renewables, or more specifically, the enormous cost reductions for wind and solar. That has mostly run its course. We see something similar for the battery costs on electric vehicles. That will run its course. But if it's true that it's more complicated than just replacing one with the other, then the first area which stands out for investment and new models of government cooperation would be the whole, not very fashionable, but still important process of adaptation. Both ananas in Scotland, but also think of the vast field of energy efficiency improvements, where the first funds have sprung up to invest in this kind of technology, saving energy. And the second one I would point out, specifically of interest, I think, for the financial community, comes from the fact that we do have overpromised already. So we have hundreds of companies who said they would decarbonize, have zero carbon emissions by some fixed date, dozens of countries who have zero carbon goals. And with current technologies, we all know they will not be able to deliver. So what do? They buy offsets.
Right.
When you fly here, you can pay £5 or something with PA, and they say your carbon emissions from this flight will be offset, but you have no idea how they will be offset. And this is an opportunity and a problem. There's a huge potential market, global market, for offsets out there. And regulators and governments have not yet accomplished a way of setting up the infrastructure for that market. So
I think there are so many aspects of this topic that we could cover, and unfortunately we've got 27 seconds left. But I think that there's time for one or two questions. If anyone would like to ask our panel any points that come to mind. Well, that's, is there a hand there? Yes, difficult to see. I didn't hear the question.
Talk a little bit more about those offsets.
What those offsets?
Okay, who would like to answer
The
that?
carbon offsets, I believe.
Right.
I can do this very quickly. There's only one model for that, which was the European carbon market 10, 15 years back. That was silently sort of buried because it basically became a huge instrument of fraud. We had all sorts of people claiming you planted 3 trees in China, and then the European Union local embassy putting a stamp on it, and then that being sold as offsets in a developed carbon, the only then developed carbon market in the European Union. Since then, it has not been touched in a systematic way. One of the persons who realized early on the potential and also the potential danger of that kind of market emerging without regulation globally was Mike Carney, who used to be head of the Central Bank of Canada and head of president of the Central Bank, or chairman, what they call it, Central Bank of England. And he set up a task force, a group, trying for this COP actually to work out a way of establishing a global market for that, where the idea is that if you create a swamp here or plant some trees here or do something which acts as a sink for carbon, as an absorber of greenhouse gas emissions, you would get certificated, you could sell these certificates, and intermediaries like British Airways or Lufthansa or whatever would buy them and then sell them to their clients, who would then pay a price for the carbon emissions, which, that's the theory, which they caused, and that would actually directly lead to a reduction in global carbon emissions because somewhere else, for that money, a swamp is created, a tree has been planted, and so on. They failed, unfortunately. And he's an experienced man with a lot of backup. He tried it for a long time, and he just could not deal with the tremendous amount of interest groups and political pressures and everybody who wanted to have a special rule and regulation for that. So this market is still there de facto. It promises to grow very fast. It's a bit like crypto, completely unregulated. It's already fraudulent in some corners. It's well-meaning in other corners. Always a dangerous mixture. And if it takes off without any sort of framework, it probably faces a very glum future, which would be bad for the whole transition project.
I hope that's going to come up at COP28 as a very important point. And well, look, we've covered some very interesting discussion points. I think our conversation could have lasted for much longer. I'd certainly, on my behalf, like to thank the panel very much. Perhaps you can give them a big hand. And we're all available for a discussion afterwards. Thank you. Thank you.